Hello friends, today we will talk about smart investing. It's a 6 episode series wherein we will go step by step into the art of investing and see how do we start investing, why to invest, where to invest, what are the instruments available for investing and what are the kind of returns that they give. There are 26 investment options which are explained in this video. So the 6 episodes that we're going to talk today is the first episode on starting your investing journey. Why to invest, where to invest, and then in the subsequent episodes we will talk about stock markets, fundamental analysis, mutual funds, other fixed income instruments and government backed schemes. So talking about investments, the art of investing and how do you start making investments. There are two approaches to investments. First one is investment is residual, which means people will always say I do not save enough to make investments. I live in today. What is the need to plan for future? And investments, what is that? You want to buy luxury items today, but you do not really know whether you're investing or not. So there, in this approach, whatever money is left behind after your all the expenses is considered as saving, and then you try to invest that. The second approach, which is a more smarter approach, is decide on your investment goal. What is your savings goal? What is your investment goal? What is it that you want to achieve in next 10 years, 15 years, 20 years? And then you start working towards that. You fix smart goals for yourself, and basis the smart goals, you decide this is my saving amount every month. Try to balance between today and tomorrow, and all the luxury items you buy only after you have met your investment goals. So this approach is what I call smart investment approach, wherein investment is not considered to be a residual number. You actively plan for your investments and you know where you are heading. Why smart investing? Now, investing can multiply your returns if you do it in the right way. There are 3 examples on this page. The first one is there is no monthly investment amount, no investment at all. 10 years, 20 years, 30 years, investment value is 0. Absolutely no planning at all. The second example is where an investor is investing 5,000 rupees every month in fixed deposits. He is a passive investor, no smart planning, but there is some money which is going every month on the saving side. Now what happens is over a period of 30 years, the total wealth created is around 41 lakh. The third example is of a smart investor. If you see 5,000 rupees being invested every month in better investment options, which gives an overall return of 10%, and in a period of 30 years, total wealth created is around 1 crore. So don't just be an investor, be a smart investor. You should know where to invest, what is the right return for you, and on that basis your investment planning should be undertaken, which is going to create a lot of wealth in the long term. So first question, how much shall I invest? How much do I start investing every month? And before you decide on that number, as I said, smart investing is about having defined goals over a period of time. And for that, you should first define what is your savings goal. How much do you want to save, or how much investment portfolio you want to have over a period of time? So in general, and that's my thumb rule, and there is no right answer to this. You can decide to have 10 lakh rupees with you when you retire, or 1 crore or 10 crores. It is your individual decision, individual choice. But in general, my thumb rule is your starting salary or your starting income multiplied by 200 to 300, and that should be the minimum goal that you should have for your retirement over a period of 30 years. So let's take an example. If your starting salary is 2 lakh rupees per annum, your minimum goal for next 30 years for your retirement kitty should be between 4 crore to 6 crore, and nothing less than that. Now, if you think this number is too less for you, you should aim for higher. Feel free, define a goal that works for you. If your income has grown much more than your starting salary, feel free to have a higher investment goal. But if you think this number is too much to achieve, then rethink on that, because what we are going to discuss today is there are various investment options which can give you good returns over a period of time to make sure that you achieve this goal. So it is not a goal which cannot be achieved. At the same time, you have to work smartly, invest in the right assets to achieve this goal. So basis your overall total goal, decide on your monthly investment amount. What I have put together is something that I consider as a minimum depending on your salary. So if you are in less than 3 lakh per annum bucket, make sure you invest 10% of whatever you earn. If you are in 3 to 6 lakh, save 20% of your income. 6 to 10 lakh, save 35%. Anything about 10 lakh rupees, if you are in that income bucket, make sure you start saving 40 to 50% of your income. So as your salary go up, your savings kitty is going to go up, your investment value is going to go up, and your returns will also get compounded over a period of time. So you will be able to achieve your investment goals. How should my portfolio look? Now this is again something that you should rebalance over a period of time. Step one is always to start safe. Always keep 3 months income or salary in liquid assets like fixed deposits. I mean, this is the only advice which I have on fixed deposits. Do not heavily depend on fixed deposit. Just keep some nominal amount in fixed deposits so that in case of emergencies you have some liquid cash, some liquid asset that you can bank on. But other than that, I would say that once you have the 3-month kitty, once you have the 3-month salary, you should be more and more confident, and you should start investing in medium to high risk asset. What I've done here is, basis your age profile, I have put together how should your investments look like, how should your portfolio look like. And this is just a tentative guideline. You can always have your own percentages. If you are less than 30-year-old, you should have good exposure in the equity market. This is the right age to take a lot of risks. So start with around 60% equity allocation and 40% in government and fixed income schemes. We will talk about these schemes in detail in the later part of this video. If you are in 30 to 50 year age bracket, do less fixed income government securities, focus more on equity and also physical assets like buying a house for yourself, buying a house for your investments in gold. Again, your risk taking ability should be high in this age bracket. And then as you move further 50 to 60, do more of government securities, fixed income, reduce your physical asset investment. By the time your home loan EMI you would have already paid, continue investing in equity. And once you retire at 60, focus more on government schemes and fixed income bracket, and focus less on other asset classes. So we have already seen why to invest, what is smart investing, how it can give you better returns, what is the amount that you should save every month. Now let's talk about what are the investment options available in India. And here we are going to talk about 28 investment options which are available to all of us for investing. So talking about the first one, government savings scheme, these are low risk instruments. Risk here is very low, and returns are moderate to high in some of the schemes. So the first one is a post office 1 year to 4 year time deposit. So these are time deposits here, which gives a return of 5.5%. Risk is very low. These are government backed schemes. There are no tax benefit in these. There is a lock-in period of 1 year for a 1 year time deposit, 2 year for a 2 year time deposit, and likewise the advantage here is very limited lock-in. So if you want to invest for 3 years, just buy a 3 year time deposit, get a return of 5.5%. Premature withdrawals are allowed with some penalty. The only disadvantage here is low returns as compared to some of the other assets. So you should invest in these if you need money in a shorter time period, like 3 to 4 year time period. There is a need for money that you have and you want to invest in a low risk asset, then these are some of the investments that you can make. Talking about the next one, which is a 5 year time deposit, similar to 1 to 4 year time deposits, you can make these deposits with post offices. The return is higher, 6.7%. Risk again is low. ATC benefit is available. ATC benefit is benefit you get on your investments. This get reduced from your total income up to 1,50,000 rupees combined with all similar ATC investments. The interest income is taxable on this one. There is a lock-in of 5 years. Premature withdrawals again are allowed with penalty. The returns are low and there is a 5 year lock-in, which is kind of a disadvantage for a 5 year time deposit. Talking about next one, the senior citizen savings scheme. This is available to individuals with age of 60 and above. Individuals with age of 50 in certain exceptions can also open this. There is a lock-in of 5 years. ATC benefit is available on this one. Interest income is taxable, but returns are high, 7.4%, and risk is very low. So this is a good scheme for senior citizens. The next one is monthly income account. This gives a monthly income. Maximum investment that can be made is 4.5 lakhs. This can be opened with any post office. 6.6% is the return on this one. So if you need monthly income, make this investment and then get monthly income. Again, return is low. There is no tax benefit. So generally, I do not recommend this one. The next one is National Savings Scheme. Good return, 6.8 one that what we have seen so far, except for the senior citizen savings scheme. Risk is very low. ATC benefit is available. Interest income on this instrument is taxable. There's a lock-in of 5 years and no premature withdrawals are allowed, which means you are locked in for 5 years. You can take a loan on the basis of these certificates, but you cannot redeem these instruments. Returns are higher than some of the other government instruments. So if you do not have any taxable income and you want to invest in a asset class which is completely safe and gives a reasonable return, you should invest in NSC. The next one is my favorite instrument, PPF scheme. There is a return of 7.1%. Risk is very low. You get full tax benefit in these schemes, which means if you make an investment on this one, you get an 80C benefit. You also get benefit on the interest income earned on your PPF account, which means interest is also not taxable. So high income individuals or individuals who are paying tax should always avail PPF scheme. There's a lock-in of 15 years, high returns on this one. The disadvantage is long lock-in of 15 years. But I still recommend this instrument because it is completely tax-free, full tax benefit with a good return of 7.1%. The next one is Kisan Vikas Patra. It gives a return of 6.9%. Risk is very low. There is no tax benefit on this. The lock-in depends on the series you are buying. Generally, it is 10 years. Premature withdrawals are allowed with a penalty. High lock-in with no tax benefit. Do not recommend this instrument. The next one is Sukanya Samriddhi. Again, a very good scheme by government. Gives a return of 7.6%. You are eligible if you have a girl child less than 10 years of age. There's a lock-in period of 21 years, and there is full tax benefit on this scheme, which means the investment is eligible for 80C benefit and the interest that you earn is also not taxable. So there is complete tax benefit on this scheme with a very strong return. So again, an instrument which I generally like. So on this chart, if you see some of the two instruments which are my favorite instruments, one is PPF scheme, the second one is Sukanya Samriddhi Yojana. Both of them have a long lock-in period but give solid return with complete tax benefit. If you are in need of money in the short term, then you can look at some short time period schemes like time deposits with the post office. But if you have a longer time horizon, invest in PPF scheme, invest in the Sukanya Samriddhi, which will multiply your returns over a longer time period. So let's talk about other investment options on the fixed income side. The first one is PF contribution, VPF, available to all salaried employees. Now this one is my favorite instrument. It gives a return of 8.5%. The risk is very low, almost negligible. There is a full tax benefit, which means investments are eligible for 80C benefit, and even the interest that you earn on VPF are fully tax free. Government has recently changed the law on this one. The benefit now is limited only up to contributions for 2,50,000. Anything beyond that is taxable. It's still a very good instrument. The lock-in is 5 years. The advantage is limited lock-in and maximum returns, highest that you see on the fixed income category side so far. Disadvantages, I do not see any disadvantage here except for the lock-in of 5 years, which is again a limited lock-in. So this one is something which salaried employees can use to maximize their return. Talking about the next one, NPS, which is a relatively new scheme. The returns are market linked, 8% to 12%. The risk is moderate because returns are linked to market. Sometimes it can go up, sometimes it can go down. Investors have the flexibility to choose whether they want to invest in high risk instrument, low risk or moderate. That flexibility NPS scheme gives. Tax benefit, 80cc benefit, similar to 80C, capped at 1,50,000 along with all other similar instruments. There's an additional tax benefit of 50,000 rupees for employee or individual's contribution on this one. The taxability at the time of maturity is little complicated. Only 60% of the amount can be withdrawn at the age of 60. The balance has to be used for an annuity purchase, which means you have to invest in an annuity scheme which gives you a monthly or a periodic income. Part withdrawal at 60 is that's why there's only part withdrawal at 60. Advantage is on the tax side. There is a tax saving, except that when you retire at 60, the 60% money that you get is tax free, but the balance 40% which you use to purchase annuity incomes are taxable. So the 40% in this scheme becomes eventually taxable when you start getting returns on an NPS scheme. Not a very, the scheme has not gained much popularity so far because one is a very, very long lock-in period. You have to wait till the age of 60 to get returns, and even at the age of 60, you can only withdraw 60% of the amount. Talking about the next one, fixed deposit, 4 to 6%. The normal fixed deposits do not have any tax benefits. The returns are low. Risk is also low. Just do not make that mistake of investing in cooperative banks just for higher interest rate sake. Invest in good scheduled commercial banks. The returns may be low, but at least your money is safe. I generally do not advise fixed deposit investments because the return is low, and especially for individuals who are paying tax, because you also have to pay tax on the interest that you earn on fixed deposits, which makes your return abnormally low. There are tax saver fixed deposits wherein you get ATC benefit at the time of investment, but again, interest income is fully taxable. Return is still 4 to 6% before tax. Lock-in period is 5 years for these tax saving fixed deposits, and returns are limited. Recurring deposit is very similar to fixed deposit, except that you invest a monthly fixed sum on a recurring deposit, and at the time of maturity you get full proceeds. So instead of one-time investment in a regular fixed deposits and recurring deposit, you save or you invest a fixed monthly amount up to the maturity period. No tax benefit. Returns are similar to fixed deposits. Talking about the next one, government bonds. Government comes out with these bonds on a regular basis. There is a lock-in of generally 7 years. No tax benefit on these. Risk is very low because these are backed by government. Return ranges between 6.5% to 7%. Again, I mean a safe investment, but if you are in a high tax paying category, then no tax benefit, so you should exercise caution. Corporate bonds again gives a very good return, 7 to 10%, but on the risk side there is a high risk because there is a risk of default. These are private sector bonds issued by different corporates. So whenever you invest, make sure you do a due diligence on the corporate itself. There are sometimes big corporates issuing these where the risk is relatively low, but then there are companies on the high risk side wherein if you buy their bonds, then you carry high risk on your investment. There is a lock-in of 1 to 5 years generally, and there is no tax benefit on these instruments. Returns are higher on the advantage side, but then you take the risk. So we talked about other fixed income instruments, and on this list, my favorite first one, PF contribution, BPF. This remains my all-time favorite. Then government bonds or bonds issued by RBI, although no tax benefit, but returns are still relatively higher. And then corporate bonds issued by different corporates gives very high rate of return, but investors have to be cautious on which corporate they are investing in. So let's talk about the next category of investments, stock markets and mutual funds. For the beginners, we will talk about different categories of investments that you make on the equity side. We will also talk about how to maximize your returns, how to make these investments and then maximize your returns in the stock markets and mutual funds in the next video, which will just focus on equity investments. So the first one is stock markets equity. This can give a very good return, 8 to 16%. In fact, returns can be higher than that. The risk is very high, and therefore you will have to do a lot of due diligence before you make your investment. Just do not listen to any tips or any advice that you get from others. You do full due diligence before you make direct equity investments, as the risk is very high. There is limited tax benefit on these instruments or on this investment because while there is no ATC, but you do get some relief on the long-term capital gains and short-term capital gain side. Returns always are very high, but it comes with a high risk. Talking about the next one, which is like an indirect exposure on the equity side, the equity linked savings scheme, 10 to 14% return. Risk is very high because mutual funds would eventually invest in the equity markets, and your returns are linked to equity markets. Tax benefit, ATC is available. Taxable on maturity, the proceeds are taxable on maturity, which means whatever income that you earn, you will still have to pay long-term capital gains tax on this one. There is a lock-in of 3 years. Advantage is high return plus some tax benefit. On the disadvantage side, there is a lock-in and there is high risk because returns are linked to market. The next one is a very simple product, mutual funds, SIP. You make fixed sum of investment every month in a particular mutual fund. Returns are 10 to 14% depending on how equity market is doing. Risk is very high because returns are linked to market. No special tax benefit. You have to pay long-term capital gains or short-term capital gains depending on how much money you make. There's no lock-in. The disadvantage is, as I said, risk is higher, so you should do a proper due diligence before you make these investments. You have to select the right mutual fund in line with your investment goals before you proceed, so that the returns are high, but at the same time you're not taking excessive risk. The third category is again on the mutual fund side very similar. Instead of making monthly investments, what you're doing is you're making a lump sum investment in a mutual fund. Rest everything remains the same. Returns are similar. Risk is high. It is linked to market. You pay long-term capital gains or short-term capital gains on your income. And as I said, the advantage is high returns, but at the same time you have to do a proper due diligence because your hard-earned money will be going to a mutual fund, which would then invest in equity market, and your returns will be linked to market. So make sure you do a proper due diligence on a mutual fund before you invest. The last one is a debt mutual fund. If you do not like investing in equity mutual funds, which are more on the high risk side, then one good option for you is debt mutual fund, which gives a return of 7 to 10%. The risk is moderate because these funds invest in debt instruments rather than equity instruments, and there is no tax benefit on these one. Advantage is moderate returns with lesser risk than a normal mutual fund which invests in equity. The disadvantage is again, you have to do a proper due diligence before you make the investment, because debt also is of different categories. Some of these invest in high risk debt, and you do not want to get trapped if you make such investments and your money also does not come back. So you have to do a proper due diligence before you make these investments, because these debt funds invest in different categories of debt. Some of these could be relatively high risk, so you should be cautious before you make your investments and do a proper due diligence on these mutual funds. So in my next video, I will definitely touch upon how do you select on mutual funds and how do you select the right stock in line with your investment needs. So my favorite ones, equity investments, CLSS for tax benefit, mutual fund, SIP, mutual fund, and I also do recommend debt in case you want to take moderate risk. So talking about the next category of options, so the first one is endowment insurance plan. You would be getting calls from different call centers, different insurance companies on this plan. It gives a very nominal to moderate return of 3 to 5%. Risk is generally low. The advantage is it combines two products, life insurance and your investment planning. So these are two things which are combined together, but returns are very low. There is a full tax benefit, which means you get ATC benefit on the investment, and whatever income that you earn is also not generally taxable. The disadvantage here is the returns are very low. Why should anyone go for a hybrid instrument when you can always take a term insurance which requires a very less premium and same time invest in high or moderate return asset. This is a traditional product which kind of gives a sense of security, but returns are lower over a period of time. The next one is ULIPs. So returns here are market linked, not a short. These invest in high risk assets, therefore risk is high. There's an ATC benefit. Proceeds also are generally not taxable in case your contribution is less than 2.5 lakhs per annum. There is a lock-in of 5 years. Advantage is tax saving and market linked returns. Again, it's a hybrid instrument. A portion of what you pay goes for your life insurance premium. The next one is annuity schemes. You get return of 4% to 8%. These are moderate to high schemes depending on which scheme you invest. There is an 80CCC benefit on investment. No tax benefit on income. Your lock-in depends on the scheme in which you are investing. The advantage here is returns are generally assured or market linked. It could be depending on which scheme you are investing in. There is a moderate risk involved. Returns are typically lower than some of the other investment options that we talked about, 4 to 8%. But this would again depend on the scheme in which you are investing, because some gives an assured return, some does not give an assured return or assure only return up to a limit, and then balance is linked to market. The next one is sovereign gold bonds. This is relatively new instrument for investors. Good part is it's again a hybrid. It gives a hybrid return. It gives price appreciation on gold plus 2.5% annual interest. Risk is moderate because the return is linked to gold prices in the market. Interest is fully taxable. The 2.5% money that you get is fully taxable, but capital gains on gold appreciation will not be taxable. So in a way, it gives partial tax benefit. There's a lock-in of 8 years on these bonds. And advantage is returns are linked to gold, so it's a good inflation hedge. If the price of gold or similar assets goes up over a period of time, this instrument will make sure that you get good returns. The disadvantage is the 8-year lock-in period. Gold ETF, similar to sovereign gold bonds, these are the returns on these ones are linked to market. The risk is moderate because returns are linked to gold prices. There is no tax benefit on these one. Long-term capital gain, short-term capital gain would be applicable. There is no lock-in period. Are traded on exchanges. Advantage is easy to buy and sell. So these are relatively liquid as compared to sovereign gold bonds, but you don't earn any interest on these ones, and there is no tax benefit on the disadvantage side. Talking about the last one on this list, real estate, buying a house, it generally gives the return of 4 to 12% depending on the area in which you buy. The risk is very high. So this is also an illiquid investment, which means buying and selling is not easy. It's not traded on an exchange, so it requires a lot of effort to buy and sell these assets, but it is a good hedge against inflation. If the prices of commodities goes up, generally you will see real estate going up. So it's a very good hedge against inflation. Tax benefit are limited. So if you want to hedge yourself against inflation and in a longer time period, this is one of the options that you should have in your investment bucket. So my favorite ones, sovereign gold bond is something that I advise, and real estate at the right time and at the right place. These are the ones that I kind of personally like on this list. We talked about 28 investment options today. In the next video, I'm going to talk about stock market investments. How do you start? How do you track markets? How do you trade? And most importantly, how do you identify opportunities in the market by doing fundamental analysis? And what is the tax impact? So the next video is going to give you a good overview of how to start trading and how to make money on the stock market. This will be coming soon. Please subscribe the channel so that you do not miss on this one. Lastly, like and subscribe for more such content. And the content of this video has been made for educational purposes. Whatever comments or whatever opinion which I had is my personal opinion. Investments are subject to market risk, so please exercise your own due diligence. Please do your own due diligence and exercise caution before you make any investments. Thank you. Jai Hind.